Greetings. This is Market Wisdom for Traders, episode 75, delivered by Twigbe Ezegeloki. For forex, stocks, commodities, futures, options, and all chart-related trading. You can contact us for account management or training. You can reach us on 080-375-97085. We have been on this for close to 2 decades now, and we have what it takes to ensure consistent profit return. You observe that penny news will move a market longer and farther than actual reported news. The anticipation of bullish news can support a market for weeks or even months. When the bullish news is eventually reported, the market may well move in the opposite direction. That is why the old adage of buy the rumor, sell the fact seems to work so well. Of course, the same logic applies to bearish news as well. Before you can analyze the bullishness or bearishness of a report, you have to be aware of what the expectations are and put the report into the context of the expectation. Also, don't judge the bullishness or bearishness of a report by initial reaction. Give the market some time to digest the news. You often find that the first reaction to a report is either overdone or incorrect. Look for markets that are encountering rising levels of demand to trade. Demand-driven markets are the markets where you can make long-term trades that produce unusually high levels of profitability. Price rallies motivated by supply concerns tend to be short-lived, and the long-term price forecasts in these supply shortage markets are generally overestimated. You may have to wait weeks or even months to take advantage of an accurate fundamental forecast. Acting too soon could easily turn an accurate forecast into a losing trade. The best analysis, fundamental or technical, is worthless in the hands of a trader who lacks decisiveness and takes no action. Seasonality of the market is a market's natural rhythm. The established tendency for prices to move in the same direction at a similar time every year. Once consumers and producers fall into a pattern, they tend to rely on it almost to the point of becoming dependent upon it. Vested interests then maintain it. You cannot expect to design an effective neural market network financial forecasting application unless you have considerable trading experience, programming, and mathematics expertise, and the time to devote to the task. There is an order to the universe. Once you know the underlying structure, you can predict market movements. The markets are a function of human behavior. The motive of human beings can be characterized by a certain structure. The most well-known structure of this type is Elliott wave theory. Here, one assumes that the impulses of fear and greed follow a distinct pattern. Elliott, in fact, decided that there were 9 categories of magnitude of waves, ranging from the grand supercycle to the sub-minute wave. Human behavior has a cycle. He who thinks he knows doesn't know. He who knows that he doesn't know, knows. Allow to sell. The key factor in your system is not the probability of winning. Instead, the key factor in determining the value of your system is its expectancy per dollar risk. Setup is about 10% or less of your trading system. Most people will place 90% of their emphasis on finding the right setup. But setups are actually one of the least important parts of the system. Setups are conditions for entry and exit in the market. New stock issues often tend to go up rapidly. They also collapse rapidly. This is a dangerous area for amateurs. Many publicly offered systems consist of nothing but setup. This brings us to the end of today's episode. Remember to subscribe and share. Thank you.